Reputable mortgage brokers can have strong connections with a wide variety of lenders, which can help clients secure better terms on a mortgage. Brokers can also be especially helpful if the borrower has special considerations that are more difficult to match, or perhaps less attractive to mortgage lenders if approached by borrowers directly. Clients with less than ideal credit ratings or debt-to-income ratios might also find brokers a helpful asset in trying to find a willing lender. The uninformed client might end up paying a higher rate by either paying the broker fee directly or having it passed on to them in the form of higher rates. As with all aspects of the home buying process, due diligence on the part of the home buyer is critical. Brokers can help facilitate the process, but because they aren't the issuers of the loan, they don't have full control of the process, which might result in unforeseen delays. Mortgage companies, mortgage banks. Mortgage banks, mortgage lenders, and mortgage companies are often used interchangeably, and that's because they are all able to originate mortgages. But there are important differences, and so here we will try to distinguish between traditional banks and mortgage companies to help clarify what those differences are. Mortgage companies now originate the vast majority of mortgages in the United States. Mortgage companies are not traditional banks, that is, they don't deal in traditional retail banking where you might have a checking and savings account. Rather, mortgage companies are financial institutions that specialize in mortgages only. It might also help to think of mortgage companies as non-bank lenders. Mortgage companies are increasing in popularity for a number of reasons. They typically offer a wider variety of mortgage product options than traditional banks because they typically sell the loans they originate rather than hold the note themselves. This might sound similar to what mortgage brokers do, and it is. The difference is that mortgage companies actually do the initial closing and funding of the mortgage. Once closed, they typically sell the loan on the secondary market. In addition, because mortgage companies specialize only in mortgages, they can help streamline the process, which might be helpful, especially in a hot market. A downside to mortgage companies is that because they typically sell your loan to another financial institution after the closing, the borrower won't know who ultimately will hold their mortgage. The terms and rates will be the same, but the financial entity will not be. This could be important for clients to be aware of, depending on their personal circumstances. As well, those with strong income and credit ratings might be able to find better rates at a traditional bank, as they might comply with banks' more stringent requirements. As always, the best mortgage product and lender is highly dependent on the needs and circumstances of the borrower. The mortgage companies that are consuming an increasingly big portion of the mortgage market are those that are completely online. In 2020, for example, Quicken Loans, also known as Rocket Mortgage, originated the most mortgages in the United States, with over 1.1 million mortgages. Freedom Mortgage, another online, non-bank lender, leapt into third place with nearly 400,000 mortgages, and loanDepot.com was fifth, with nearly 300,000 mortgages. Freedom Mortgage made the biggest jump from the previous year and focuses on loans for lower to moderate income borrowers. The company finances loans through FHA, VA, and USDA programs. In 2020, the average mortgage loan issued by Freedom Mortgage was $255,000, which was the lowest of the top 10 mortgage loan originators in the United States. Though mortgage companies have become increasingly popular in recent years, it's not as if traditional banks have disappeared. They still make up a large share of the mortgage market. In 2020, the household banking names of Wells Fargo, JP Morgan Chase, and Bank of America all were in the top 10 mortgage originators. Banks will originate and fund the mortgage to a borrower, but whereas in years past banks might have retained the mortgage, it's common now for banks to package and sell these mortgages on the secondary market as well. Let's look at some of the pros of receiving a mortgage from a traditional bank. Traditional banks might be a better option for borrowers with higher incomes and credit ratings. In contrast to mortgage company Freedom Mortgage, which, at $255,000, had the lowest mortgage average of the top 10 originators in 2020, JP Morgan Chase had the highest mortgage average of the top 10, at $472,000. Banks engage in traditional depository activities, such as offering checking and saving accounts, which can make having all major banking needs located in one institution convenient for some people. Similarly, banks sometimes can provide retail products, such as checking and savings account offers, to those who open a mortgage through them. On the downside, for borrowers without the most ideal income and credit ratings, getting a mortgage through a traditional bank could be more difficult because banks typically have more stringent requirements and they offer fewer loan products. And just as some people might find special offers on other banking products, such as checking and savings accounts, beneficial, other people might find these sales tactics aggressive and annoying. As always, the pros and cons are contingent on the borrower's finances, goals, and circumstances. Credit unions. Credit unions are not-for-profit banking institutions. They are similar to traditional banks in that they typically offer a range of banking services and products, such as checking and savings accounts. The major difference between credit unions and traditional banks is that credit unions are owned by its customers, or members, rather than outside investors. Typically, credit unions are focused on a specific demographic of the population, like teachers or members of a branch of the military. Consequently, this not-for-profit organizational structure and specific focus on a segment of the population means that mission of the credit union is to focus, above all else, on its members. Borrowers who belong to a credit union might be able to find lower rates, better terms, specialized loan products for their needs, as well as more personalized attention. One big disadvantage is that non-members of the credit union won't be able to attain any of these benefits. Also, similar to traditional banks, some borrowers may be put off by cross-selling of other banking products while applying for the mortgage loan. Finally, similar to mortgage companies, as well as some traditional banks, credit unions often sell the loan after closing, so the borrower may not know who will ultimately be financing their mortgage. Mortgage brokers can be valuable intermediaries in the home buying process, but they also have their own set of advantages and disadvantages. Here are some pros and cons of using mortgage brokers. Pros. 1. Access to multiple lenders. Mortgage brokers work with a variety of lenders, including banks, credit unions, and private lenders. This means they can provide you with a range of mortgage options, helping you find the one that best suits your needs. 2. Expertise. Mortgage brokers are usually well-versed in the mortgage industry. They can guide you through the complex mortgage application process, offering advice and recommendations based on your financial situation. 3. Time and energy savings. Brokers can save you time and effort by doing the legwork for you. They can help you complete the paperwork, gather necessary documents, and negotiate with lenders on your behalf. 4. Potential cost savings. Mortgage brokers may have access to exclusive deals or wholesale rates from lenders, which could potentially save you money on your mortgage in the long run. 5. Customized solutions. Brokers can tailor mortgage options to your unique financial situation, increasing the likelihood of finding a mortgage that matches your needs and preferences. Cons. 1. Broker fees. Mortgage brokers are typically compensated through lender-paid commissions or fees from borrowers. This could add to the overall cost of your mortgage, so it's essential to understand their fee structure before committing. 2. Conflict of interest. Some brokers may have financial incentives to recommend certain lenders or products. This could potentially lead to recommendations that are not in your best interest, so it's crucial to ask questions and understand how the broker is compensated. 3. Limited control. By using a mortgage broker, you relinquish some control over the mortgage application process. You rely on the broker to make key decisions, which may not align with your preferences. 4. Not all lenders included. While brokers work with multiple lenders, they may not have access to every lender in the market. This means there could be some lenders or deals that you miss out on by using a broker. 5. No direct relationship with lender. When you work directly with a lender, you can establish a direct relationship, which may be helpful in the long run for customer service and future mortgage needs. Brokers act as intermediaries, and you may not have the same direct connection to your lender. In summary, mortgage brokers can be valuable for many home buyers, especially if they have complex financial situations or if they want to save time and effort during the mortgage application process. However, it's essential to carefully consider the potential drawbacks, such as fees and potential conflicts of interest, before deciding to work with a mortgage broker.